The father of value investing predicted the index fund crisis 75 years before anyone called it a crisis. Benjamin Graham wrote exactly one paragraph in 1949 that Wall Street ignored and financial advisors dismissed, and that paragraph explains why your retirement account is participating in an experiment Graham predicted would fail, with you as the subject rather than the scientist. What makes this strange is that Graham wasn't warning against index funds at all. He was explaining why they would eventually stop working. Passive investing only works when most people aren't doing it. And that's not opinion, but mathematics. Graham understood this before Jack Bogle founded Vanguard, before the S&P 500 index fund existed, and before BlackRock's assets under management crossed $10 trillion. A principle about markets that we've collectively chosen to forget because forgetting felt more convenient than facing what it meant. Two economists named Sanford Grossman and Joseph Stiglitz would formalize this exact insight in 1980 and nearly win a Nobel Prize for the work. They called it the information paradox, which states that markets can't be perfectly efficient because if they were, nobody would have any incentive to do the analysis that makes them efficient in the first place. Graham intuited this 30 years before they published, and we ignored both warnings. Picture Benjamin Graham in 1949, sitting in his office at Columbia Business School. By this point, he's already a legend in finance. His 1,934-book Security Analysis, which he co-authored with David Dodd, had invented the discipline of fundamental analysis from scratch. The Great Depression hadn't just failed to destroy him financially, it had sharpened him intellectually, because he figured out why the crash happened and built a framework to prevent getting destroyed by the next one. His investment partnership, Graham Newman Corporation, had been beating the market for 2 decades using principles that seem obvious now, but were revolutionary then. Principles like buying companies for less than their worth, demanding a margin of safety, and treating Mr. Market as a manic depressive servant rather than a guide. This approach was a direct assault on what would later become the efficient market hypothesis, the theory championed by Eugene Fama at the University of Chicago, which holds that prices already reflect all available information. Graham thought that was nonsense. The market wasn't efficient in his view. It was efficient-ish, maintained by the labor of people like him, and removing that labor would cause the efficiency to decay like a garden nobody tends. But in 1949, Graham isn't writing about how to pick stocks. He's writing The Intelligent Investor, which will become the most influential investment book ever written. Warren Buffett, in his 2013 letter to Berkshire Hathaway shareholders, called it by far the best book on investing ever written. And buried in that book is a warning that almost nobody quotes, that almost nobody teaches, and that explains the exact problem we're facing right now. Graham wrote about what he called the self-defeating nature of popular investment strategies, and his argument was deceptively simple. Any approach to investing that becomes widely adopted will, by the very nature of that adoption, stop working. Not might stop working, will stop working, because the mechanism is automatic. Call it Graham's paradox. Strategies succeed until they're adopted widely enough to destroy the conditions for their success. Value investing had its paradox phase in the 2000s, when too many investors hunting for undervalued stocks made undervalued stocks nearly impossible to find. Passive investing is entering its paradox phase now. The connection between a 1,949 value investors warning and your Vanguard account is more direct than you'd expect. Graham understood something about markets that we've obscured with financial jargon and comforting narratives. Markets are not natural phenomena like weather or earthquakes that follow physical laws regardless of human behavior. Markets are entirely composed of human decisions, which means every price you see is the output of millions of people deciding what something is worth. And here's what matters. For prices to be accurate, someone has to be doing the work of making them accurate. Someone has to analyze company financials, compare competing investments, identify when a stock is overpriced and sell it, or spot when it's underpriced and buy it. This process is called price discovery, and price discovery is labor that requires time, expertise, and the willingness to be different from everyone else. Physicists would recognize this dynamic immediately. In thermodynamics, you can't measure temperature without adding or removing energy from a system, and markets have the same property because you can't invest without changing prices. The question becomes whether your investment adds information or noise. Active investing is signal, passive investing is entropy. Graham ran his analysis process at Graham Newman with religious discipline. His analysts would calculate intrinsic value using metrics like net current asset value, which is what you'd get if you liquidated a company's current assets, paid off all liabilities, and ignored everything else. Stocks trading significantly below this conservative floor got bought, stocks trading above got sold or ignored, and the margin of safety, that gap between price and calculated value, was everything. This process created information with every transaction. Each time Graham bought an undervalued stock, he signaled that the price was too low, and each time he sold an overvalued one, he signaled the price was too high. Multiply this by thousands of active investors doing similar analysis, and you get a market where prices actually mean something, not perfect meaning, but meaning. Now watch what happens when we translate Graham's framework to passive investing. Value investing has analysts calculating intrinsic value, while passive investing has algorithms tracking an index. Value investing aims to buy mispriced assets before the market corrects, while passive investing aims to own everything regardless of price. Value investing sends information to the market through buying and selling, while passive investing sends nothing but pure noise. The mechanism is identical, just inverted. Active investing creates market efficiency while passive investing consumes it, and Graham understood that efficiency is not an infinite resource but a commons, and commons get overgrazed. Ecologists call this phenomenon a trophic cascade. Remove the wolves from Yellowstone and the elk population explodes, which causes them to overgraze the riverbanks, which kills the trees, which drives away the beavers, which erodes the rivers, and the entire ecosystem tips because one regulatory mechanism was removed. Markets have the same structure. Remove enough active investors and passive capital floods into the largest stocks unchecked, which erodes the price signals, which tips the information ecosystem. Think of it another way. Active investors are the workers who fill potholes, repaint lines, and update signs, while passive investors are drivers who use the roads but don't maintain them. When most people are maintaining, the few drivers have smooth roads, but when most people are just driving, the roads deteriorate. That deterioration isn't obvious at first because the roads built by previous workers remain usable for years, even decades. You can convince yourself that road maintenance was always unnecessary, that the roads just exist in good condition naturally, right up until they don't. We've crossed Graham's threshold, and most people don't realize it. In 1995, index funds held about 5% of the US stock market. Today, passive strategies including Vanguard's index funds, BlackRock's iShares, State Street's SPDR funds, and the legions of closet indexes control well over 50%. Analysis from S&P Dow Jones indices puts true passive ownership at 60% or higher when you include funds that claim to be active but effectively track benchmarks. This isn't a gradual shift. This is a phase change. And Graham's paradox tells us exactly what happens next. The first mechanism Graham identified was what he called the popularity trap. When an investment approach works well, more people adopt it, but the very act of adoption changes the conditions that made it work. Graham was talking about value investing, where if everyone hunts for undervalued stocks become rare, and the strategy's success destroys its opportunity set. Passive investing operates this mechanism differently but even more powerfully. Index funds don't hunt for undervalued stocks. They buy stocks based on market capitalization, which means the bigger the company, the more shares they buy. What this creates is a self-reinforcing loop. Money flows into index funds and flows disproportionately into the largest stocks. And this buying pressure pushes large cap prices higher. And higher prices mean higher market caps, and higher market caps mean index funds must buy even more of those stocks. The feedback loop has no natural breaking point. The data shows this clearly. The Magnificent Seven technology stocks, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, now represent roughly 30% of the S&P 500's total value. This concentration isn't purely because these are the best companies. It's partly because passive inflows mechanically push capital toward whatever is already biggest. Graham would have recognized this instantly as a popularity trap of unprecedented scale. The actionable insight here isn't to panic, but to understand that index fund prices aren't pure signals of value anymore. They're contaminated by flow dynamics that have nothing to do with fundamental analysis. When you buy an S&P 500 fund, you're not buying the market in some neutral sense. You're buying a momentum-weighted portfolio that systematically overweights whatever has already gone up. The second mechanism cuts deeper, and Graham called it the information problem. Active investors generate information through their research, their trades, their successes and failures, all of which creates the data that markets need to function. When active investors identify an overpriced stock and sell it, that selling pressure brings the price down toward fair value, and when they identify an underpriced stock and buy it, that buying pressure brings the price up. This process is messy and emotional and often wrong in individual cases, but in aggregate it works because prices converge toward reality when people are betting real money on their assessments of reality. Passive investors don't generate information, and they explicitly refuse to. The entire philosophy of passive investing, articulated by Burton Malkiel in A Random Walk Down Wall Street and institutionalized by Bogle at Vanguard, holds that trying to generate information is futile. You can't beat the market, so you should just own the market. This is rational for any individual investor, but when most investors adopt this stance, nobody remains to generate the information that makes prices accurate. This is the Grossman-Stiglitz paradox in action. The economists proved mathematically what Graham intuited, which is that if enough people assume markets are efficient, markets become inefficient. Efficiency requires effort, and free riding on other people's effort only works when enough other people are making the effort. The symptom is already visible if you know where to look. Research published in the Journal of Financial Economics found that stocks heavily owned by index funds show weaker price responses to earnings surprises. In the 1990s, the correlation between a stock's fundamentals and its price was reasonably strong, with good earnings leading to higher prices and bad earnings leading to lower prices in simple cause and effect. That correlation has weakened dramatically today for stocks heavily owned by index funds. A company can report disappointing earnings and see its stock price rise simply because passive inflows overwhelm the fundamental signal, or a company can report great earnings and see its stock fall because it's not in the right index, or its weighting is too small to attract meaningful passive capital. Michael Burry, the investor made famous by The Big Short, has been warning about this for years. His comparison puts index funds alongside the subprime CDOs he bet against in 2008, not because they're the same financial instrument, but because they share the same structural flaw. Both assume an underlying process will continue functioning even as they grow large enough to distort that process. And there's an even deeper parallel most people miss. The index fund's structural flaw is identical to Soviet Gospelin's flaw, because both systems assume prices contain accurate information while eliminating the decentralized process that creates accurate information. Soviet central planners thought they could set prices by decree and still have those prices mean something, and index funds think they can allocate capital by market cap and still have market caps mean something. One system collapsed in 1991, the other is still running, but the mechanism is eroding underneath. The actionable insight is this: if you're going to invest in index funds, and for most people they're still the most sensible default, you should understand that you're free riding on the price discovery done by the shrinking minority of active investors. That's not a moral judgment, it's a structural fact, and that structure becomes less stable as the free rider proportion grows. But that's not even the most important mechanism Graham identified, because the third one is where it gets really uncomfortable. Graham called it reflexivity, though that term wouldn't be popularized until George Soros used it decades later in his theory of financial markets. The principle is simple. In markets, the act of observing changes the thing being observed, which means your beliefs about market prices don't just reflect reality, they partially create reality. Passive investing operates this like an autoimmune disorder, with the market attacking its own price discovery mechanism, the way lupus attacks healthy tissue. Index funds don't just track the market, they change the market's structure. When index inclusion and exclusion moves billions of dollars, regardless of company fundamentals, companies start optimizing for index inclusion rather than business quality. When market capitalization determines capital allocation, companies focus on boosting their stock price rather than generating real economic value. When passive flows dominate price formation, price signals stop meaning what they used to mean. We're already seeing this play out. Companies obsess over index eligibility criteria, and the SEC has noted increasing corporate attention to index construction rules. Stock buybacks, which boost share prices and market caps without creating any new value, have exploded partly because executives know that higher prices mean more passive inflows, which mean higher prices, which mean bigger bonuses. The feedback loop contaminates corporate strategy. And here's Graham's deepest insight. This process is invisible until it fails. Markets look efficient, prices look meaningful, returns look acceptable, and everything seems fine right up until the moment it isn't. The 2008 financial crisis didn't announce itself in advance, and housing prices looked rational right up until they weren't, because the mechanism had been broken for years before the break became visible. Graham didn't predict index funds specifically, but he predicted the exact failure mode they're creating, which is a market that looks efficient because of historical momentum, while the actual mechanisms that created efficiency erode beneath the surface. The roads look fine, but nobody notices that the maintenance crews went home. Graham wouldn't tell you to sell everything, he'd tell you to understand what you own. First, recalibrate your expectations. The extraordinary returns of passive investing over the past 40 years happened during a period when passive investing went from negligible to dominant. Money flowing into index funds pushed prices up, and this wasn't pure economic growth being captured, because part of it, impossible to quantify exactly, was structural inflation caused by the passive revolution itself. Future returns may look very different as passive flows stabilize or reverse. Second, think harder about diversification. True diversification isn't owning 500 stocks through one index fund. It's owning assets whose returns are driven by different mechanisms. If index fund concentration is a risk, the hedge isn't a different index fund. It's assets that don't depend on the price discovery mechanism. Index funds are degrading things like real estate, private businesses, international markets less dominated by passive flows, or individual securities chosen by actual analysis. Third, and this is the uncomfortable one, consider whether some active investing is worth it. Not for most of your portfolio and not with most of your time, but Graham's logic suggests that the opportunity set for active investors grows as passive dominance increases. When most investors have abandoned price discovery, the prices they've abandoned become less accurate, and less accurate prices mean more opportunity for those willing to do the work. This isn't a reason to trade frantically or pay 2% management fees for closet indexing. It's a reason to understand that the mantra about not being able to beat the market assumes a market full of people trying to beat it. Remove those people, and the assumption weakens. Becoming a day trader is not the lesson here, and Graham would be horrified if his warning became an excuse for active management fees. The point isn't that passive is bad. The point is that passive only works because active exists, and we're eroding the foundation while standing on the building. What Benjamin Graham figured out in 1949, and what the financial industry still won't acknowledge, is that investment strategies are not neutral tools. They shape the markets they operate in, which means a strategy that works beautifully when rare may fail, catastrophically when universal. The margin of safety, Mr. Market, intrinsic value, these aren't just stock-picking techniques. They're expressions of a deeper truth, that sustainable returns require someone to do the work of creating them. Markets don't maintain themselves, efficiency isn't free, and when everyone assumes someone else is paying the bill, eventually you find out the bill was never paid at all. Next time you buy an index fund, and you probably should still buy index funds because they remain the best option for most people most of the time, ask yourself Graham's question. Who is doing the price discovery that makes this price meaningful? If you can't answer that question, you're trusting a process you don't understand. And Graham spent his entire career warning about the dangers of trusting what you don't understand. The best investment strategy isn't the one with the lowest expense ratio or the most impressive historical returns. It's the one whose mechanism you can explain, whose assumptions you've examined, whose failure modes you've considered. Graham understood that, Buffett understood that, and Grossman and Stiglitz proved it mathematically. The index fund industry, which has built a $50 trillion edifice on the assumption that you don't need to understand mechanisms, really doesn't want you to understand that. Benjamin Graham and Jack Bogle, two figures who seem philosophically opposed. One championed rigorous analysis while the other championed ignoring analysis entirely. But the underlying principles connect in a way neither would have predicted. That's what we do here. Find the hidden structures that connect ideas everyone treats as separate. Architecture principles explain algorithm design, and restaurant kitchen systems reveal the flaws in agile methodology. And next week, we're examining why the same mistake that destroyed Kodak is baked into how we train large language models. Leave a comment with the biggest assumption you've never questioned about your own investment strategy. Graham would want to know.